Okay, so hello everybody. My name is Pramesh Tyagi. I'm MTech in Applied Geophysics and an oil and gas professional for 20 years. For last 3 years, since 2017, I am working in crypto industry. So I'm working on my own. This is like blogging, researching, trading and investing. The experiences that I have gained over last 3 years, I now think are significant, and I would like to share some of those experiences as I have accrued and with you all. So that's about me. On this channel, YouTube channel, this is the introduction. If you will go to my channel, you will see my introduction there and some links to the key posts that also you will see over there. Here, these are the different posts. Basically, what I'm going to discuss today or in future in my videos, the technical details of my research. If you would like to refer to, then please go into the about section of this channel and click on those links and read about them. So that's more about the me you can find through other links like I'm on Hive, I'm on Twitter with Vulture Speak, on Facebook, on Actanon, LinkedIn. This is my professional profile, my Twitter profile, and I'm on Medium as well. So these are the places you can go and read more about me and what I have been sharing over there. So coming back to the agenda that will be there for these videos generally will be day data. In the day data, I will be discussing hodl wave fractals and price fractals. In intraday data, I will discuss about stable coins and Bitcoin from blockchain. The information is extracted from the blockchain. Then intraday FNO data, there I will be discussing about futures and options, data mostly derived from derivative exchange. And if there is any important news, then I will be discussing about that also. So then going to the day data, I already asked you to refer to the technical details in about section. There you will see a post about these fractals that I compute and what is the significance and importance of these fractals. Here I am showing the fractals for hodl waves and the price waves. So on the hodl waves I am showing for the third interval, and here the data is starting after the third halving, which I call the fourth interval, and this is on 12th May 2020 where the halving happened. So all this data is after that, and the data here is scaled. These hodl waves are scaled by the values that were there on 12th May for the respective hodl wave. And the hodl waves that I am displaying here are 7-day hodl wave, 30-day hodl waves, 60-day hodl wave, 90-day, 180 days, and 365-day. I'm also showing the close BTC, for which the scale is here on the right hand side. So what do we see here in the hodl waves? after the third halving event is, and as when you go to uh, my post regarding these fractals given in the link in my about section, then you will see that the 7-day hodl wave, if it is below 1 and even particularly close to zero point 0.6 or 0.7, which is currently the case with the 7-day hodl waves, and these hodl waves are pretty low, then that is an indication that a significant upward move it will be possible after this. Moreover, other hodl waves are also, as of now, are close to 1. So that is also a good sign that there has not been any significant accumulation by the hodlers since the halvening. Okay, so this is a good sign that from here onward there is a good expectation that the prices will go up. On the lower chart, lower part of this chart are the price history comparison of 4 intervals. So here what you will see, and I'm also displaying the close price of the PTC in red. Here if you will see that we are almost there as far as the scaled prices are concerned, slightly up around 10% or so from where the halving happened on 12th May. And if we see it with respect to what has happened in the previous time, I mean the last halvening, then you will see this chart, and here this is the first halvening, this is after the second halvening, and this is after the third halvening, which has already gone, and this is now the ongoing third halvening and the fourth interval. So one can see that if the hodl waves are below 1 after the halvening and before the ATH for that particular interval, then that is a reasonable time to accumulate. So we can see now that from the hodl waves that since the halvening no significant accumulation has happened. However, if we look from the price, then this is the time where actually the accumulation should have happened or will happen even after that. So these two things actually are now suggesting that from here onward the downside is very low. However, the upside is very significant, and as you can see, last time it went all the way to 30 times. It went to 30 times, and this time even if it goes to 10 times, that will be pretty significant. There will be one more graph that I will share with you. So here is what you are seeing, the price comparison history of all these intervals, and here you can see that this yellow curve is now touching the gray curve, and the gray curve is basically the scaled price of the third interval. So we either will during this phase, we either will track the gray curve or will be slightly lower the gray curve, and we will see how it evolves. But currently it is almost there. Therefore, we see there is no possibility as of now actually for any significant correction. In fact, it should now go up. Okay, so that was about the day data. Now we will go about the intraday data, which is for the stable coins and the Bitcoin. So this is the first chart now that you will see, and in this chart we are looking at the total liquidity. Green curve is showing the total liquidity. So okay, first let me tell you what are the axes. On the left hand side is the axis for the closing price of the Bitcoin. On the right hand side is the total supply of all the stable coins, all the dominant stable coins, and the current, and on the x-axis is the number of samples. So this sampling, that the data I am collecting is at around 5 to 10 minutes. So these are 10,000 samples. So normally this data is around for a month. So now this chart, as you can see, for over last 1 month, and the green chart here, green curve here is the total token supply, means total stable coin supply, which is now around 1.9 billion plus. Then other two curves, gray and the orange. So orange is the liquidity inside the exchanges, and means the stable coin supply inside the exchanges, and gray is the stable coin supply outside the exchanges. Both are increasing, but it will be much better if gray orange curve is above the gray curve. That means more liquidity inside the exchanges to support the asset prices like the Bitcoin. Okay, now we can use this data to compute the ratios. So this is the next slide, which shows the stable coin ratios. So here on left hand side, left hand axis is for closing price of BTC. Right hand side axis, y axis, is the ratio of different among the different stable coins, and x axis is the number of samples, which is for last 1,000 samples. So last 1,000 samples is nearly 300. On per day basis, you can expect around 200 samples, 250 sample. So it's 4 days of data that we are displaying here. And black curve, green, let's look at first the green curve. Green curve is the outside and inside liquidity ratio, means outside exchange total stable coins divided by inside exchange stable coins, and it is that. So normally we would like it to be less than 1, but but this is even today, even as of now, it is above 1. So it's not a very strong support for a buy, but not very strong support for sell also. Case for sell also. Orange curve here is the same kind of ratio for outside and inside, but now it is time weighted. So time weighted uh, of outside and inside the exchanges for last 8 hours, that is 100 samples. Okay, and the black curve is again same, but for only for those addresses which have been active over last 24 hours. Okay, so the address that are active on for last 24 hours or outside the exchange and inside the exchange, it shows the ratio for those liquidities. Normally, what I have observed for my last 1 year, from my last 1 year research, is if the green curve is above the orange curve, then it's a possibility that the prices will go up from here and there will not be any significant correction. And if it is other way around, then the correction can take place. Okay, so that was about the stable coins. Now I will discuss about the Bitcoin supply. So again, total active Bitcoins. This is what I am collecting, and how many Bitcoins are active. So in this curve, green curve shows how many total Bitcoins are active. Okay, and the scale is on the right hand side. On the left hand side, the scale is for BTC close price. The other two curves here are orange and the gray. Orange shows the BTC, active BTCs inside exchanges, and the gray shows active BTCs outside exchanges. And now, obviously, if anybody would like to have less and less Bitcoins on the exchanges, so this orange curve should be, if goes down, then it's a case that prices will increase, and if it goes up, then prices are expected to decrease. So these two, this data can be then used to compute the ratios for BTC as we computed for stable coins. So here on this slide, you will look at those ratios, and here there are two ratios of the so BTC OIR BTC, outside inside ratio of BTC, means outside the exchanges divided by inside the exchanges BTCs is shown in orange, and if it increases, means chances it will the prices are expected to go up. If it decreases, then prices are expected to go down. Similarly, as we did in the stable coins, we can compute the time weighted average of the active BTCs inside the exchange and outside the exchange and take the ratio of that, and that's what it is shown here in green. It's quite noisy, as we can expect, but still we can see and that if it also increases, means there is a possibility that the prices will increase. If it decreases, possibility the prices will decrease. Okay, so this chart, next one, I call it the SDR, supply demand ratio chart. So supply of the BTC and demand by measured by the liquidity. Okay, so we can do this for total supply divided by total demand, and that curve here is shown in which one? Black curve. So black curve shows total BTC, active BTCs multiplied by its price divided by the total liquidity of measured by stable coins. And the orange curve shows inside exchange BTC multiplied by its price divided by inside exchange stable coins. And the gray curve shows outside BTCs multiplied by its price divided by outside stable coin liquidity. So these are the three curves, and then the green curve shows the difference between orange and gray curve. Basically, it's measuring a kind of um, difference between the outside and the inside supply demand ratio. And this also what we have seen over, I have seen over last 1 year since I'm doing this analysis, that obviously supply demand ratio would say that lower these curves are, these three, or orange, green, no, orange, black and gray. Lower they are means chances are that the prices will go up, and they definitely, if lower than 1, yes. And if they increase and particularly go above 1, then definitely the prices are expected to decrease afterwards, because there is not enough liquidity to support that much supply on the exchanges or outside the exchange or the total active bitcoins. The green curve, normally what I have seen, if it is on the lower side less than 0.2 or 0.3, it suggests that the prices will increase. Means there is a kind of balancing act has happened between the various market participants who are active inside the exchange and who are active outside the exchange. If this ratio is low, significantly low, means basically there is a kind of equal distribution of bitcoins and liquidity inside and outside the exchanges, and therefore a balance has kind of occurred. So this is a reasonable price discovery, and from here onward the prices are expected to increase. This is what I have seen. This is normally what has been happening, and I use it for that purpose. All right, so that was the 4 different. Then further analysis also can be done of supply and demand, and the next curve is the supply over of the BTC on exchanges. So here is I do this measurement by looking at the change in BTC, not the balance in the BTC of the BTC on address, but the change of the BTC on a particular address. Is it that? No, it's that it's the cumulative change of the BTCs on active addresses that were there in the last 24 hours and now, and basically that's that difference I compute for inside the exchanges addresses and outside the exchange addresses, and then I basically kind of plot them here, and I use it to measure that how the supply is changing over last 24 hours inside the exchange and outside the exchange. So if the supply is is increasing inside the exchanges, means prices are expected to go down. If supply is decreasing outside the exchange, so basically if gray is above the orange curve, then the prices are expected to go up. If gray is below the orange curve, prices are expected to go down. So that was about the supply chain for last 24 hours. And similarly we can do for demand, means the liquidity change over last 24 hours. And here it has, I'm seeing it up the opposite behavior, that the outside liquidity should increase for the prices to increase afterwards, and inside liquidity should increase for prices to go down afterwards. So these are the two slightly opposite, basically it's an opposite behavior of change in supply in last 24 hours and change in demand over last 24 hours. Okay, there is one more thing that I measure for the Bitcoin, and that is the change in Bitcoin. So not the, I'm here not looking at the balance in an address, but here I am looking at how much the balance in an address, active address over last 24 hours has changed. Okay, and for all the active addresses that are there at this moment, I compute on all those addresses how much change in BTC has happened on those addresses. And again, I know which address belong to the exchange address and which address belong to outside the exchanges. So the difference of that inside and outside is plotted here. That's why I call it diff BTC. And here on the right hand side is what you see. If the difference is negative, means it is outside minus inside, means more Bitcoins are coming into the exchange. If difference is positive, means more Bitcoin are going on to active addresses outside the exchange. It's 24 hour sum is what that I then compute in the next slide. And here you can see, if orange curve, as I have explained, are the change in BTCs inside the exchange, that's what it shows, and gray shows change in BTCs outside the exchange. Obviously, one can expect if orange curve is above the gray curve, then prices are not expected to increase. In fact, they are expected to decrease. And if orange curve is below the gray curve, then prices are expected to increase. And that's what it can be used for. Okay. Afterwards, I have another interesting computation, and that computation is Gini index. So Gini index is used to compute the wealth distribution of countries among its population. I do that here for Bitcoin as well as for stable coins. For all the active, and here the difference is I do it for the active addresses. The addresses that are active over last 24 hours for stable coin as well as for the Bitcoin. So that's the difference. So here what you will see again on the left hand side is the scale for the Bitcoin price. On the right hand side is the ratio of the Gini indexes, and bottom is the x-axis. Again, the data is here for 1000 samples, nearly 4 days. And I'm finding it a bit difficult to still you understand, and I'm seeing conflicting behaviors. Although if you look at the post uh, that I have given as a reference in my introduction, normally if the Gini index goes down, so in that post I came to the conclusion after analyzing various things that there has to be an optimal distribution of wealth among its participants for any ecosystem to perform the best. And when I say perform the best means its valuation should increase. So if Bitcoin valuations have to increase, then optimal distribution has to be there. Now, what is the optimal distribution? Optimal distribution again will change depending on which stage we are in. So in the early stage, if it's a different value, a different value of Gini index will determine the optimal distribution. But as the adoption increases of Bitcoin, means as the time passes and the adoption increases, more and more people start using the Bitcoin or start coming to this ecosystem, then a different value of Gini index will represent an optimal distribution of wealth, and normally it should decrease. So it should start with a higher value and then should decrease. If it does not decrease, then the system will not have the optimum distribution and will not have the maximum appreciation of it will not work with its maximum efficiency. Okay, so slightly complex here, but I suggest you please refer to my post on this issue, and the Gini index decreases, and particularly for the outside the exchanges, then prices should go up, and if the Gini index increases, then the prices should come down. Basically means there are only bigger players who are supporting the price, and there is not a participation by wider participants. Its opposite behavior is what that I expect on the stable coin. Means if for the stable coins the Gini index increases, means the price of the BTC should decrease, and if the Gini index of stable coins decrease, then the should increase.